What's going on? Welcome back to the channel. So today I want to talk to you about Serve Robotics. They recently did come out with their earnings. I want to go over some of the absolute key highlights from those earnings that you need to kind of take away from all of that. And then aside from all of that fun stuff, what analysts are saying and everything else. But first, make sure to hit that thumbs up. And with that, let's get right to it. So Serve went down 6.19% on Friday, 697 the low, 790 the high. So absolute craziness. And when it comes down to the recent earnings, I feel like a lot of institutions saw a lot of red flags and kind of started to pull back. So even on Friday, with it going down and much of the greater market pushing up because of what Powell stated, you didn't really have many institutions buying the dip. So 6.1 million shares being traded, 10.6 was the average. And so these are all the transactions that did occur on the secondary market above $100,000. So despite over the last 1 month it being down like 59.84%, big money's not really kind of buying the dip, if that does make sense. So insinuating there is a little bit more downside coming. But there was a couple of things that did come out. So like I said, their earnings, they did miss on earnings per share, revenue, and future guidance. I'm going to go over in a second near the end of the video, but even that wasn't all that great. It kind of shows more 2026 and onwards will be good for the company, but nothing really worth buying over. At the same time, they did submit a S3, so it does show more dilution coming. So S3 is a shelf offering, good for 3 years, so it doesn't mean it's happening straight away, but the market always immediately prices it in as though it is. So it looks like 300 million, and so that's not the best type of scenario. But again, based on their earnings, they're kind of burning through quite a lot of cash, and that's what the market doesn't like right now. The market punishes any company that is not being efficient. And unfortunately, Serve is in a very speculative sector right now. So again, I think just naturally Wall Street is going to not really favor it. But when it comes to shorts, even on Friday, they did increase 366,000 shares. 24.81% of the free float is being shorted. Works out to be 7.14 million shares overall are being shorted. Cost of borrow average 15.69%. Utilization is 91.71. So given everything, I would have anticipated shorts to really double down. But even looking at the intraday, they hit kind of hard first thing, but they didn't really do all that much. At the peak, they were kind of increasing 1.1 million, but still nothing really overly crazy given the circumstances. So I see a lot of people on social media saying that Friday was because of shorts. It wasn't actually them. It was just institutions selling. Just unfortunately, it was below that 100,000 threshold on the secondary market. Dark pool, there was only 4 transactions. So some institutions were selling through that format, but still nothing overly crazy. Looking at the options, you had 400,000 in calls, 1.01 million in puts. 55% of all the options being done were optimistic in nature, but it is somewhat difficult to distinguish only because whenever shorts do increase, sometimes they hedge just in case there is going to be a little bit of a recovery. So this bullishness might actually be more like a misrepresentation of shorts just hedging. So again, it's not truly bullish if you ask me, but of the call options that were purchased, there seems to be a consensus for it to be around 8 to 850 going into this upcoming week. Bears are anticipating for it to be sub 650/7, so more further downside coming. Data points coming out this week. You do have JOLT numbers on Tuesday, CPI on Wednesday, so that could make for a very interesting week. But with it at $7.43, trading between this S1 and this S2, so $4.27 is a strong support. Flip side, $7.77 is going to be that next strong target/resistance. So in the short term, you really want to watch for it to get above that 777 if you're going to see any sort of recovery. But essentially you see 2 ratings that did come out. So given the fact that it did go down, like I said, 60%, you would assume that analysts would be somewhat covering it or paying attention to it, but even despite everything, nobody's really willing to put their neck on the line for that, other than 3 firms that are very low named and not really popular. So you had one right here, so Seaport, Aaron, who has a 65% success rating, did give a $11 price target, buy, mind you. There was also Northland Michael, who has a 45% success rating, did reiterate the $23 rating. So as a consensus, $17 is that price target, representing a 128.8% upside. So given everything, if you have a long-term time horizon on this stock, then yeah, take advantage of these dips. Because yeah, based on their future guidance and everything, 2026 and onwards should be good. But until that time, I think there's a little bit more pain. But this is one crazy pullback that has happened. So it is below the ALMA, below pretty much all the key pivotal moving averages that I like to look at. It is considered very oversold as well, looking at the stochastic RSI. So not really much to really bring up for this. So yeah, let me know your general thoughts on all of that in the comments below. But I did kind of go through the transcript, and this is some of the absolute key highlights that you need to kind of take away from their earnings, including their future guidance. So you can kind of see that they did have some planned expansion. So that's going to be outside of Miami. So it looks like they're going to be reaching LA. They did state that there's going to be the second half rollout. They did reiterate their 2,000 targets. So that's their plans for 2025. Also expansion to Dallas and Atlanta. So that should be good. But I think, as you can kind of see at the very last point, future outlook, strong demand anticipated for 2026 and beyond. So that is, yeah, that's kind of where you should see some maybe actual return on investment overall. But like I said, I think it is definitely not worth buying coming from an institutional standpoint. But if you believe in it bigger picture, take advantage, buy the dip, do what you need to do. So let me know your general thoughts on all that. Don't forget to hit that thumbs up and subscribe. I always greatly appreciate that. And then one final thing, pop over to my Patreon and give good buy signals on stocks, options, and crypto. Many of them have been absolutely on point and bangers. Definitely worthwhile to pop over there and take a look. With all that, appreciate all of you watching.